A slew of earnings reports this week. Our next guest suspects there'll be lots of commentary on the earnings call about how companies are preparing for upcoming policies in the United States. Let's bring in Carol Schleif, Chief Market Strategist at BMO Private Wealth. Carol, the Trump administration is now weeks away from taking office. There's a report that's getting a lot of attention in the in the Washington Post this morning that the administration may water down its approach on tariffs. How important is Trump administration policy to the overall mood of markets right now?
Well, in the short run, policy and policy expectations in terms of what happens near term, what happens longer term will be very instrumental in driving short-term market sentiment, but it won't mask in the intermediate and longer term what's going on with fundamentals, and those remain very strong. As you mentioned in the opening segment, we've got earnings coming up over the next couple of weeks, and companies will be able to respond to that. But we do expect very heightened volatility in the short run as markets absorb every social media post, every commentary, every article in newspapers and try to back it through in terms of what will the impact be on companies' earnings, consumers' business choice.
Do you think expectations are set high for corporate earnings this year? There's been a lot of talk about elevated multiples on the S&P 500, that earnings have to grow by something like 13.5% to validate those multiples. What are your thoughts on the reporting season that we're about to enter?
You did see market multiples expand last year, even as earnings came in a bit better than expected. We do continue to expect to see earnings for the next 4 or 5 quarters come in high single digits, low double digit ranges, which would allow the markets to grow into those earnings multiples. You're not necessarily going to see more earnings multiple expansion from here, but companies definitely need to perform. There is a lot of exuberance, if you will. Exuberance is probably too strong a term, but there's a lot of optimism in the markets, if you will, about the chance for reduced regulation, reduced taxes, or at least holding taxes steady where they're at, and potentially a much more amenable environment for mergers and acquisitions and IPOs. And all of that has nice undergirding for the potential to juice earnings in addition to the solid fundamentals we have going on.
How much conversation do you expect on conference calls? How much commentary from top executives do you expect on the Trump administration and the potentially radical set of policy alternatives that it may bring to bear?
Well, whether or not they put it in their formal documents, they'll be peppered by analysts with questions for that company by company. And that's where we think more than usual, the next few quarterly earnings report seasons will be rife with a lot of scrutiny about what's said and what's said between the lines about how companies plan to adjust to or respond to what's stated. For example, tariffs. You mentioned tariffs earlier. Our companies, did they preload with not only from a tariff perspective, but from a potential East Coast port strike perspective? Did they preload inventory into the fourth quarter, bring it in? Where are they at? Where are they at in rearranging their supply chains? There'll be a lot of attention paid to that. And so the earnings and whether they're hitting or missing will be almost a sideshow relative to all that commentary that people will be hanging on every word from company by company and trying to roll it up and aggregate industry by industry as well.
Stock market investors were not thrilled when the Fed made it clear that 2 rate cuts in 2025 is the most likely number. Have markets become accustomed to that now? Have they digested that and accepted it, and are investors willing to move on?
You know, we were a little perplexed at the vehemence of the reaction to the Fed's dot plot, because the dot plot moves around a lot, and it's, as many of the governors said before and after, it's a single point in time when they're asked to assess incoming information. I think part of the surprise came too is that some of the governors, when asked, Chair Powell did mention that some of the governors may or may not have started to let potential policy changes influence their opinions. But that dot plot, if you recall, a year ago, markets were discounting 6 or 7 rate cuts, a total of 175-ish kind of basis points. We got 100 basis points across 3 cuts that didn't even start until September, and we still closed the markets close to all-time highs. And so we suspect the one downside to that is that the Fed's hawkish stance forces all of us to be very data dependent. So the jobs number out on Friday, every data piece that comes in will be hyper analyzed for what it means for potential for Fed policy. But it's important to remember too that a Fed that is choosing to hold at somewhat higher for very longer because growth is strong is different than a Fed that's holding steady because inflation is running rampant again. So we suspect that markets in the intermediate and longer term will do what they always do, which is focus on earnings, focus on underlying fundamentals. Are companies making progress? And we suspect the answer will be yes.
And on balance with all of those moving parts in the background, you think 2025 can be another year of good market gains?
We do, and we definitely think when you look at the underlying fundamental trends, the rollout of artificial intelligence, rollout more broadly of robotics, lots of technology implementation, greening of the grid, or sturdying of the grid, all of that sets up an environment not at all unlike when we were building out internet infrastructure in the early and mid 90s. And we think we're in the earlier innings of that and that we've got some time to run on that.
Carol, thank you so much. As always, Carol Schleif is Chief Market Strategist at BMO Private Wealth.